Stop what you're doing right now. I just received confirmation from two separate Swiss refiners in the last 90 minutes. They have declared force majeure. They cannot deliver 1,000-ounce silver bars to clients. At the same time, silver just gapped up to $108.50 per ounce in Sunday overnight trading. It broke through the psychological $100 barrier that held for decades. And here's what changes everything in the next 12 hours. A major electric vehicle manufacturer just authorized a direct off-market purchase of 50 million ounces of silver, bypassing ComEx entirely. They are not waiting for the market to open. They are securing physical metal right now while everyone else is asleep. This is John AG. What you're watching is not a price rally. This is a commercial failure, a supply chain breakdown. The physical silver market is separating from the paper silver market in real time, and the institutions that need metal for production are running for the exits. The $108 price you're seeing is not speculation. It's panic buying by entities that cannot afford to wait for ComEx to settle contracts in March because they know ComEx does not have the metal. When Swiss refiners, the entities that turn raw silver into deliverable bars, declare force majeure and say they cannot source metal, that tells you the primary supply chain has fractured. And when an EV manufacturer bypasses the largest futures exchange in the world to buy 50 million ounces directly, that tells you the smart money knows the paper market is finished. System collapses don't happen randomly. They happen when the math stops working. And the math in the silver market stopped working 72 hours ago. Let me show you exactly what I am tracking right now because the data I'm seeing is not being reported anywhere in the mainstream financial press. My contact at a major precious metal desk in Zurich texted me at 11:47 p.m. Eastern. His exact words: "We cannot source bars. Clients are paying $15 over spot. Delivery timelines are 8 to 12 weeks. This has never happened. That's a 14% premium over the already elevated spot price of $108. And the delivery timeline, normally 48 hours for large institutional orders, has extended to 3 months. That is not a market experiencing high demand. That is a market experiencing supply failure. While everyone focuses on the $108 price, I'm tracking what's happening in the lease rate market. Silver lease rates, the annualized interest rate that banks and institutions pay to borrow physical silver, just hit 45%. Let me be very clear about what that number means. In a functioning market, lease rates for a commodity with no credit risk and liquid futures markets should be between 0.5% and 3%. When lease rates hit 10%, it signals stress. When they hit 20%, it signals severe shortage. At 45%, it signals that entities holding physical silver are not willing to lend it at any reasonable rate because they believe they will not get it back. The shorts, the institutions that sold silver they didn't own expecting to buy it back cheaper, are now paying 45% annualized just to borrow the metal they need to cover their positions. That is a death spiral. And it's happening right now while most traders are off for the weekend. Let me connect this to the EV manufacturer purchase because this is the piece of intelligence that tells you how dire the situation has become. My source in the wholesale physical market confirmed the details. A major automotive company, widely believed to be Tesla based on the order size and the solar panel division's silver needs, just executed a direct purchase of 50 million ounces. That's 10% of annual global mine supply. They did not go through ComEx. They did not buy futures contracts. They went directly to primary producers and large holders, paid a significant premium over spot, and secured physical delivery over the next 90 days. Why would they do that? Because their supply chain analysts ran the numbers and realized that if they wait for ComEx March delivery, they risk getting cash settled instead of receiving metal. And if they get cash settled, their production lines stop. Solar panel manufacturing requires silver paste. There is no substitute. No silver, no panels, no revenue. So they're paying $110, $112, maybe $115 per ounce off market to secure guaranteed physical delivery rather than gambling on ComEx honoring contracts. Now, let me explain why Swiss refiners declaring force majeure is the signal that the entire physical supply chain is breaking. Swiss refineries, specifically the major facilities in Ticino and Valais, are the intermediaries between primary mines and end users. They take raw silver from mines, refine it to 999 purity, cast it into 1,000-ounce bars that meet London good delivery standards, and ship it to vaults, exchanges, and industrial users. When a Swiss refiner declares force majeure, they are legally stating that due to circumstances beyond their control, they cannot fulfill contracted deliveries. The circumstances beyond their control in this case are that they cannot source raw silver feedstock. The mines are producing, the ore is being extracted, but the refined bars that industrial users need are not available in sufficient quantity at current prices. This is what's called an input bottleneck. And it's not a temporary logistics issue. It's a structural shortage that has been building for years and is now expressing itself in a price that forces commercial failures. Let me show you the mechanics of how we got here, because the commercial failure you're seeing at 108 silver is the inevitable outcome of a market that has been running a deficit for 5 consecutive years. Global silver mine production in 2025 was approximately 850 million ounces. Industrial demand, primarily from solar panels, electric vehicles, 5G infrastructure, and electronics, was approximately 620 million ounces. Investment demand, primarily from coins, bars, and ETFs, was approximately 250 million ounces. That's 870 million ounces of demand against 850 million ounces of supply. The deficit gets filled by above-ground recycled silver and inventory drawdowns from vaults. But here's the critical data point. ComEx registered silver inventory, the metal available for immediate delivery against futures contracts, has fallen from 320 million ounces in 2022 to 103 million ounces in February 2026. That's a 68% decline in less than 4 years. The inventory that was supposed to buffer supply and demand is nearly depleted. And when inventory depletes while demand continues to exceed supply, you get commercial failures. Entities that need metal cannot obtain it at the paper price. So they bypass the paper market entirely and pay whatever the physical market demands. Here's the real-time intelligence that confirms we are in the final stage of this breakdown. My contact at a major bullion bank in London sent me data showing that the London spot price, the price for immediate physical delivery in the wholesale market, is trading $22 above the ComEx futures price. That spread, called the basis, is normally between $0.20 and $2 per ounce. A $20 basis means that physical buyers are willing to pay $22 more per ounce than paper traders to get guaranteed delivery. That spread has widened from $7 on Friday to $20 on Sunday night. In 48 hours, the physical premium has more than tripled. That rate of change is what you see when a market is transitioning from stress to failure. And the entities driving that premium higher are not speculators. They are industrial users, solar manufacturers, EV producers, electronics companies that need silver to continue operations. They are bidding up the physical price because the alternative is production halts. Now let me walk you through what happens when Asian markets open in approximately 4 hours, because the chain reaction that's about to unfold will determine whether this is a controlled repricing or a disorderly collapse. Shanghai Futures Exchange opens at 9 a.m. local time, which is 8 p.m. Eastern on Sunday. Silver futures in Shanghai are already trading at a $31 premium to ComEx based on Friday's close. If that premium widens when trading resumes, and I expect it will given the Sunday overnight gap to $108, Chinese industrial buyers are going to accelerate purchases. China consumes approximately 200 million ounces of silver annually, primarily for solar panel production and electronics. If Chinese buyers, seeing the Swiss Force Majeure announcements and the off-market Tesla purchase, decide they need to secure supply immediately, the buying pressure will cascade. Shanghai buys, which forces global dealers to source metal from London. London tightens, which forces European buyers to bid up prices. European prices rise, which forces U.S. refiners and dealers to raise premiums. And the entire global physical market reprices higher in a matter of hours. Let me show you why the lease rate at 45% is the mathematical proof that the short squeeze is executing right now. Lease rates represent the cost of borrowing physical silver for a specified period, typically measured in annualized percentage terms. In a normal market, if you need to borrow 10 million ounces of silver for 30 days, you might pay 2% annualized, which works out to about $16,000 in interest for that month. At 45% annualized, you're paying $375,000 in interest to borrow the same 10 million ounces for 30 days. Entities do not pay $375,000 in interest unless they are desperate. And the entities paying those rates right now are the ones who sold silver short, expecting to buy it back cheaper, and are now facing margin calls and delivery obligations they cannot meet. They need to borrow physical metal to deliver against contracts they sold. But the lenders, the entities that own physical silver, know that if they lend it out, they may never get it back because the borrower might default. So they're charging 45% as compensation for that risk. This is not a liquid, functioning market. This is a market in failure mode where counterparties no longer trust each other. Here's the emergency money trail that explains who is buying at $108 and why. Based on data from wholesalers and refiners I've spoken to in the last 6 hours, the buying is coming from 3 sources. First, industrial users securing supply for Q2 and Q3 production. Solar manufacturers, EV producers, electronics companies that cannot afford production disruptions. They are paying $108, $110, $115 because the cost of not having silver is higher than the cost of paying a premium. Second, sovereign wealth funds and central banks reallocating into hard assets. I have unconfirmed reports that 2 Middle Eastern sovereign funds have been accumulating physical silver over the last 90 days. The quantities are not disclosed, but the pattern of large block purchases through London dealers suggests institutional scale accumulation. And third, short covering. Hedge funds, banks, and trading firms that sold silver short at $75, $80, $85 are now facing catastrophic losses at $108 and are scrambling to buy back positions before losses become terminal. That buying is what's driving the gap up in overnight trading. It's not bulls pushing price higher. It's shorts being forced to cover. Let me now explain what the 108 price means for the broader financial system, because silver is not just a commodity. It's a critical input for technologies that underpin the energy transition, the digital economy, and national security infrastructure. If industrial users cannot source silver at any price, solar panel production slows. If solar panel production slows, renewable energy targets get delayed. If renewable energy targets get delayed, governments face political pressure and economic consequences. At the same time, if EV manufacturers cannot source silver for battery management systems and electric motors, vehicle production slows. If vehicle production slows, automakers miss revenue targets, supply chains contract, and employment falls. This is not a speculative bubble. This is a supply crisis with real economic consequences. And the entities that understand those consequences are the ones paying $108 right now to avoid worse outcomes later. Here's the data point that tells you how fast the situation is accelerating. On Friday, February 13th, silver closed at $98.40 per ounce on ComEx. On Sunday, February 15th, it's trading at $108.50 in overnight markets. That's a 10% move in 48 hours. But more importantly, it's a move that happened over a weekend when most participants are not actively trading. The entities driving that move are not retail traders. They are institutions with access to over-the-counter markets, direct relationships with refiners and dealers, and the ability to execute large block purchases outside of exchange hours. They are moving because they have information that the retail market doesn't have yet. They know what the Swiss refiners know. They know what the EV manufacturers know. They know that the physical market is separating from the paper market, and they're positioning before Monday's open when the rest of the world wakes up to the new reality. Now let me connect this to ComEx inventory, because the March delivery period, which starts February 27th, is the moment when the paper market either proves it can deliver or admits it cannot. As of February 10th, ComEx registered silver inventory stood at 103.5 million ounces. Open interest for March contracts represents approximately 85,000 contracts, or 425 million ounces of notional silver. If even 30% of those contracts stand for delivery, that's 127.5 million ounces demanded against 103.5 million ounces available. The math doesn't work. ComEx would face a delivery shortfall of 24 million ounces. Now, in a normal market, most contracts roll forward or cash settle before delivery, but this is not a normal market. This is a market where Swiss refiners cannot source bars, where EV manufacturers are buying 50 million ounces off market, and where lease rates are 45%. In this environment, contract holders are not rolling forward. They're demanding delivery because they know if they don't take metal now, they may not be able to get it later at any price. Let me show you what the three asymmetric plays are right now, because if you understand what's happening, you can position before Monday's open. The first play is physical silver held outside the ComEx system, not SLV, not futures. Physical bars and coins in your possession or in allocated storage. The reason this is asymmetric is that the premium over spot is widening in real time. Dealers in the US are currently quoting $18 to $24 over spot for generic silver rounds. That premium was $8 to $12 on Friday. It has doubled in 48 hours. If you own physical silver purchased at lower premiums, you're holding an asset that is repricing higher independent of the spot price. When spot is $108 and retail premium is $24, you're selling at $132. That's a 22% markup over the paper price. And that markup is widening because retail buyers cannot access the wholesale market where 50 million ounce orders are being executed off market. The second asymmetric play is silver miners that are not hedged. Companies that produce silver and sell into the spot market without forward hedging contracts. And when spot price gaps from $98 to $108 in 48 hours, unhedged miners see their revenue increase by 10% instantly. But more importantly, if the physical premium continues to widen, miners with direct sales channels to industrial users can sell above spot and capture that premium directly. First, Majestic Silver, for example, operates a bullion store where they sell coins and bars directly to retail buyers. When retail premiums are $24 over spot, They're earning $132 per ounce on sales that cost them approximately $18 to $22 per ounce to produce. That's a $110 margin per ounce. At current production rates, that translates to hundreds of millions in additional revenue that the market hasn't priced in yet. This is a leverage play on the physical premium, not just the spot price. The third asymmetric play is understanding that when the commercial failure becomes public, when ComEx either restricts delivery or admits they cannot fulfill contracts, the regulatory and political response will be swift. Governments cannot allow critical supply chains to collapse because of commodity market dysfunction. The likely outcome is direct intervention. Either the U.S. government releases strategic silver reserves, which exist but are not publicly disclosed in size, or they implement price controls and allocation mandates for industrial users. Both outcomes are bullish for physical holders in the long term, but create short-term volatility. If you can stomach that volatility and hold physical through the intervention, you are positioned for the post-crisis repricing when the market structure gets rebuilt with physical delivery as the foundation instead of paper leverage. Now, let me give you the forward-looking indicators that tell you whether this situation stabilizes or accelerates over the next 72 hours. First, watch the Shanghai premium when markets open in 4 hours. If the premium over ComEx widens beyond $35 per ounce, that tells you Chinese industrial buyers are panic buying. Second, watch for additional force majeure declarations from refiners. If Perth Mint or Royal Canadian Mint announce they cannot deliver, that confirms the supply chain breakdown is global, not just Swiss. Third, watch ComEx trading volume on Monday. If volume spikes above 150,000 contracts in the first hour, that tells you institutional money is rushing to cover shorts or take delivery positions before the March deadline. Fourth, watch for public statements from major industrial users. If a solar company or EV manufacturer publicly confirms they're experiencing silver supply constraints, that confirms the commercial failure thesis. And fifth, watch the gold to silver ratio. If it compresses below 40 to 1, that tells you silver is being remonetized as safe haven money in addition to industrial demand. Here's the question that determines whether any of this matters to you personally. Do you believe that a market experiencing Swiss refiner force majeure, 45% lease rates, $22 physical premiums, and 50 million ounce off-market purchases by EV manufacturers is functioning normally? Or do you believe we are watching a commercial failure unfold in real time where the paper price has lost connection to physical reality? If you believe the latter, then you understand why $108 silver is not expensive. It's the beginning of the repricing. The entities paying $108 right now are not speculating. They are securing supply before the system admits it cannot deliver at any price. And when that admission comes, whether it's a ComEx delivery restriction, a refiner default, or government intervention, the price you pay for physical silver will not be determined by futures markets anymore. It will be determined by what you can negotiate directly with someone who owns metal and is willing to sell. Let me address the skeptics who will say this is fear-mongering or manipulation. The data I'm citing is publicly verifiable. ComEx inventory is published daily. Lease rates are quoted by bullion banks and reported by Bloomberg. The Swiss refiner force majeure can be confirmed through industry contacts and will likely be reported in trade publications within 48 hours. The $108 overnight price is visible on futures data feeds. The only piece that's not public is the off-market EV purchase. And I'm reporting that based on multiple sources in the wholesale market who have no incentive to fabricate a $5.4 billion transaction. This is not a prediction. This is a description of what is happening right now. The market is failing, the shorts are trapped, the industrial buyers are bypassing exchanges, and the price is repricing higher to ration the available physical supply. Here's the timeline I'm tracking for the next 7 days. Monday, February 16th, Asian markets open, and we see if Shanghai premium widens. U.S. markets open, and we see if ComEx volume spikes. Tuesday through Thursday, watch for additional force majeure announcements and industrial user statements. Friday, February 20th, we get the weekly ComEx warehouse stock report showing how much inventory drained during the week. And Thursday, February 27th, first notice day for March delivery when contract holders must declare their intent to take physical or roll forward. If delivery requests exceed available inventory by a significant margin, ComEx will need to either restrict delivery, offer cash premiums for settlement, or admit they cannot fulfill contracts. Any of those outcomes confirms the commercial failure thesis and likely sends price significantly higher as confidence in paper contracts collapses entirely. Let me now give you the action framework because understanding this is only valuable if you position before Monday's open. If you own physical silver purchased at lower prices, do not sell into paper spot, sell into physical premiums, or hold. Dealers will pay you spot plus premium, which right now is $24 to $30 over spot, depending on product. That's your real exit price, not the paper quote. If you're looking to buy physical, understand that premiums are widening and delivery times are extending. Lock in prices and delivery now rather than waiting to see if spot falls, because even if spot falls, premiums will likely widen further, keeping your all-in cost stable or higher. If you're trading futures or mining stocks, understand that volatility is about to spike. The gap moves, the overnight sessions, the headline risk from force majeure announcements and industrial supply constraints will create massive swings. Position size accordingly. And if you're skeptical and want to wait for confirmation, that's fine. But understand that confirmation in a commercial failure scenario comes in the form of delivery restrictions, refiner defaults, and production halts. By the time the mainstream financial press confirms what I'm showing you now, the physical premium will be $50 over spot, and you'll be on a 16-week waiting list for delivery. Here's where we are stated with the precision, the data, I'm tracking permits. Silver gap to $108.50 in Sunday overnight trading after breaking $100 on Friday's close. ComEx inventory is 103.5 million ounces against March, open interest representing 425 million ounces. Shanghai opens in 4 hours. U.S. markets open in 16 hours. First notice day for March delivery is 12 days away. The commercial failure is executing. The supply chain is fracturing. The shorts are trapped in a 45% lease rate death spiral. Industrial users are securing supply off market because they cannot trust exchanges to deliver, and the price is repricing to ration the available physical metal. This is John AG. The commercial failure started 72 hours ago when Swiss refiners could not source bars. It accelerated 48 hours ago when silver broke 100. It confirmed 90 minutes ago when my sources reported the off-market 50 million ounce purchase. Asian markets open in 4 hours. The window is slamming shut. Subscribe immediately to track the next stage of this failure, because what happens between now and March 1st, notice day, will determine whether this is a repricing or a default. And if you're waiting for CNBC to tell you there's a silver supply crisis, you will be reading about it 3 weeks from now in an article explaining why your solar panel order got delayed and your EV delivery got pushed back 6 months. The crisis is executing right now. Position accordingly. This is John AG, and I'll see you in the next one.